Hi guys, in this video, we're going to go over the 9 common investing mistakes that you are making which is hurting your returns. If you're able to overcome these mistakes, you're going to be able to maximize your returns, which will allow you to continue generating your personal wealth. So let's jump right into it. The first mistake which you are making, which is killing your returns, is not investing into an index fund. An index fund, in my opinion, is the single greatest investment a normal person can make. Instead of gambling and trying to find out that one stock that has a fraction of a percentage chance to make you a 300% return, you should focus your investment on the tried and tested method of investing into an index fund. For the past 50 years, the return on the S&P 500 averages at 10% per annum, far greater than most investments out there. You cannot buy the actual index fund itself because it's a stock market index, but there are plenty of ETFs around the world that tracks index funds such as the S&P 500 and many others. Each country will have their own ETFs. For example, the select few countries who are able to invest into Vanguard, you could invest into their ETF called VU, which tracks the S&P 500 index fund. By having this one fund, you are getting exposure to all 500 companies listed on the US stock market, meaning that if one company had to lose a lot of its value, you'll still be in a pretty safe position as your risk will be well diversified in this fund. The other massive benefit to investing into an index fund is that the expense ratios are extremely low. For example, Vanguard's VU's expense ratio is just 0.03%. What is an expense ratio, you ask? Well, that's the next investing decision which could be killing your returns. Not paying attention to an expense ratio while investing is an extremely common mistake made by many rookie investors. An expense ratio is the yearly fee that any investments such as an ETF or a mutual fund will charge you for investing on your behalf. The typical Vanguard investment charges just 0.05% per year on your investment. So here's an example. If you invested $10,000 for the year in one of Vanguard's funds, they will charge you just $5 in fees per year. However, there are many companies out there that will charge you closer towards the 1 and 2% expense ratio. And in my opinion, this is extremely high. It's best to stay away from such investments. The maximum expense ratio fee on your investment should not be more than 0.5% per year. Have a look at this graph from the SEC, which shows the effects of having an investment with an expense ratio of 0.25%, 0.5%, and 1%. As you can see, the portfolio with the 1% expense ratio will have $30,000 less than the one with 0.25% over the course of 20 years. Important to know that this chart is showing the numbers based on a 4% investment return per year. Investing into the S&P 500 index fund, that 4% will be a lot higher, which means that the $30,000 difference will also be much greater. Paying high fees is not in your best interest. The companies which charge you such high fees, the money for these fees just go to the fund manager, and these fund managers make a ton of money, and they never really beat the market anyways. Another financial mistake that could be costing you some returns, and that is hiring a professional financial accountant. I know this is not what most of you were expecting on this list, but consider this. When it comes to pure investing, most good financial accountants will just recommend you to invest into an ETF which tracks the S&P 500, which is pretty easy to do for yourself. And the shady financial advisors will look to make a profit off of you by persuading you to invest into mutual funds with massive expense ratios. They'll get a cut from bringing in a new client into the mutual fund, and the fund managers will make a fortune off of you by charging you more than 1% expense ratios per year. Now, where a financial advisor can come in handy is when you need to plan, as in planning for your retirement, tax planning, or estate planning. If you have liked this video so far, then please consider liking the video and subscribing to my channel. The next mistake people make when it comes to investing which hurts your returns is that investors try to time the market. And that's completely understandable. Most people don't want to invest at an all-time high, as they think that they would rather buy when there is a dip in price. However, I'm here to tell you that you shouldn't wait to time the market, as that dip may never come, which could cost you returns in the future. Even though the market may be at an all-time all-time high, you don't know how high the market will actually go. There have been times where the market has had bull runs for years before making a single dip. And if you ever come across a situation where you invest into the market and the market goes down, don't get too panicked about it, as over the long term, the markets will always go up. Have a look at this image where it shows how the S&P 500 has performed over time. A study done by Charles Schwab where from 2000 to 2020, he compared 5 different investment styles. The investment style which did the best was the ones where the investors timed the market. Keep in mind that very few people can actually successfully achieve this. However, the 3 other investment styles are not that far behind. Even the person who invested at the worst possible time is doing pretty well compared to the person who sits with their cash. This image just proves that investing immediately is the best way for 99% of people out there. Mistake number 5, which could be killing your returns, is not reinvesting your dividends. Investments gives you the opportunity to have your dividends put straight into your bank account or reinvested back into your investment. If you don't need the money, then the best thing for you to do would be to reinvest the dividends. Primarily because this can greatly help increase the value of your investment through compounding over years. If you don't know how to reinvest your dividends, my suggestion would be to get in contact with your company you made the investment with and ask them to do this on your behalf. Have a look at this investment where it shows you the difference your portfolio would have if you don't reinvest your dividends versus if you do reinvest your dividends. This image will convince anyone in the world that withdrawing your dividends is not a good idea. The next mistake is buying individual stocks. Most people buy individual stocks when they hear all the hype around a certain stock, not knowing a single thing about that company or fully understanding the risk in investing into the stock. Sure, there will be the odd few people who beat the market by luck, but 99% of people can't consistently beat the market. In a recent interview done, Warren Buffett said that 99% of investors should not even attempt to beat the market. He said they would be much better off investing in a low-cost S&P 500 index fund. Mistake number 7, killing your returns, is emotional investing, which ties in with buying individual stocks. Back in 2021, when GameStop was going through the hype train, many people got emotional and bought into the stock. Sure, many people walked out with some profits. However, there have been cases where many have lost a lot of money. Also, back in 2021, when Bitcoin was going through one of its bull runs, many people sold their homes and invested the money into Bitcoin, only for it to then lose over half of its value a year later. Now, I'm not saying don't invest into cryptocurrency at all, but invest a very small percentage of your net worth in this, not more than 5%. And when you do invest into cryptos, invest only into Bitcoin and Ethereum, as they are the biggest coins in the crypto world. But for your biggest investment, the best thing for 99% of people is to just invest monthly in a low-cost investment fund by automating it and completely forgetting about it. This is proven time and time again to be the best, safest, and easiest investment out there. Investment decision number 8, which could be hurting your returns, is not investing in the correct place at your age. If you're in your 20s, generally this is when you would want to be aggressive in your investments, as in the event you do lose your money, you still have many years to go before retiring, which of course will allow you time to build back your investment. Now, unless you are completely risk averse, the general consensus is that the younger you are, the riskier your portfolio should be. An example of this would be for a 20-year-old to be investing 90% of their portfolio into the market and 10% into bonds. Bonds being the safe investment. At each decade increment, you should re-look at the portfolio and consider dropping your risk. An example of this would be once you're in your 30s, maybe you'd want to change your portfolio to 80 or 85% into the market and 20 or 15% into bonds. It all depends personally on what your risk appetite is. And the final investment mistake costing you your returns is trading. Now, this touches on buying individual stocks I mentioned earlier in the video. However, I would like to speak a little bit more about it, especially considering the amount of people who have been getting into trading recently. Now, whether this is forex trading, options trading, crypto trading, the risk you put yourself in this is massive, especially considering 95% of people are unsuccessful at trading. We have all heard those few people who made it big into the crypto crypto world, but trust me, majority of those people made their money just from getting lucky. For most people out there, it's equivalent to going to the casino and winning big there. Hope you guys have enjoyed this list. If you have, then please consider liking the video and subscribing to my channel. Until the next one, bye.